in aggregate, they have underperformed index funds, and it's the nature of the game. They simply cannot overperform in aggregate. There are too many of them managing too big a portion of the pool. And for the same reason that the crowd could not come out here to Exarban in the past years and make money in aggregate because there was a bite being taken out of every dollar that was invested in the pari-mutuel machines, that people that invest their dollars elsewhere through money managers in aggregate cannot do as well as they could do by themselves, creating their own index fund, or it'd be easier to have just to buy into an index fund. It's, they say in this world you can't get something for nothing. But the truth is money managers in aggregate have gotten something for nothing. I mean, they've gotten a lot for nothing. And investors have paid, and the corollary is investors have paid something for nothing. And that doesn't mean that people are evil. It doesn't mean that they're charlatans or anything. It's the nature. If you've got a $6 or $7 trillion or whatever it may be equity market, and you have a very significant percentage of it managed by professionals, and they charge you significant fees to invest with them, and they have costs when they change around, they cannot do as well as unmanaged money in aggregate. And it's the only field in the world that I can think of. And Charlie will think of some others, but where the amateur, as long as he recognizes he's an amateur, will do better than the professional does for the people whose money he's handling. And therefore, if I were in a teaching this class or speaking to that class, I would probably tell them that for their own psychological well-being, they should probably leave the room. Charlie? We would be willing to take any money management organization in the world managing $10 billion or more, and in the case of brokerage houses who have their brokers in aggregate handling $10 billion or more, and we would be willing to bet that their aggregate investment experience over the next 5 years or 10 years for the group that they advise will be less, will be poorer than that achieved by a very low cost index fund. And we'd put up a lot of money to make that wager with anybody that would care to step forward. Gambling may be illegal, but now you can do it through something called derivatives, you see. And we could create an instrument that would allow that, even though it might be against the laws of the state of Nebraska. Charlie, would you join me on that? Or?
Well, I certainly agree with you.
There's one more person I would like to introduce to you today, and I'm quite sure he's here. I haven't seen him, but I understood he was coming. There's I believe that he's made it today, and that is Jack Bogle, who I talked about in the annual report. Jack Bogle has probably done more for the American investor than any man in the country. And Jack, would you stand up? There he is. Jack Bogle, many years ago, he wasn't the only one that was talking about an index fund, but it wouldn't have happened without him. I mean, Paul Samuelson talked about it, Ben Graham even talked about it, but the truth is it was not in the interest of the investment industry of Wall Street. It was not in their interest actually to have the development of an index fund, because it brought down fees dramatically, and as we've talked about some in the reports and other people have commented, index funds overall.
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30 year period, I would pick a fund. And I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field. But I would be very careful about the costs involved because all they're doing for you is buying that index. I think that the people who buy those index funds on average will get better results than the people that buy funds that have higher costs attached to them, because it's just a matter of math. If you have a very high percentage of funds being institutionally managed, and a great many institutions charge a lot of money for doing it and others charge a little, they're going to get very similar gross results but different net results. And I recommend to all of you reading John Bogle's written a couple of books in the last 5 years, and I can't give you the titles, but they're very good books, and anybody investing in funds should read those books before investing, or if you've already invested, you still should read the books, and it's all you need to know really about fund investing. So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time. As to the criteria as to when you should or shouldn't, I don't think there are any great criteria on that. I don't think price-earnings ratio determines things. I don't think price-book ratios, price-sales ratios. I don't think there's no single metric I can give you, or that anyone else can give you, in my view, that will tell you this is a great time to buy stocks or not to buy stocks or anything of the sort. It just isn't that easy. That's why you go to an index fund, and that's why you buy over a period of time. It isn't that easy. You can't get it by reading a magazine. You can't get it by watching television. You can't. You'd love to have something that said if PEs are 12 or below or some number you buy, and if they're 25 or above you sell. It doesn't work that way. It's a more complex business than that. It couldn't be that easy when you think about it. So if you are buying an index fund, you are protecting yourself against the fact that you don't know the answers to those questions, but you think you can do well over time without knowing the answers to those questions, as long as you consciously recognize that fact. And I would, if you're a young person and you intend to save a portion of your income over time, I just say just pick out a very broad index, and I would probably use the S&P 500. I think if you start getting beyond that, you starting to think you should be in small caps this time and large caps that time, or this foreign stock. And as soon as you do that, you're in a game you don't know. You're not equipped to play in all candor. That would be my recommendation, Charlie.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now.